I just recorded this whole video and forgot to share my screen, so I'm doing it again. Let's get to it. They're seeing sky high iPhone 14 Pro demand, which you would think is a good thing. That means Apple's coming out with a new iPhone. They're seeing good demand. That's what you want. There's also some notes in here from, let's see, we're looking at AppleInsider.com talking about the demand of the Apple Watch, okay? So a lot of people are excited about Apple stock. I think Apple's a great company, but I don't think the stock is a buy right here. I think it's overvalued. I'm going to tell you the exact price that I would be willing to consider Apple to purchase. Before I get into that, I want to introduce myself. I'm Austin. I'm building a $1 million portfolio right here on YouTube and sharing every step of the journey. We're at $94,500. Today we were up about 1% or about $1,000 all time. And this is since February 15th, 2022 this year. We are down about $2,800. If you like this transparency, I do portfolio reviews right here on the channel, talk about everything I own, what I bought this week, all that stuff right here on the channel. I do it on Fridays. So just do me a favor, like the video, that helps us grow, and then subscribe to the channel and turn your notifications on so you never miss an update. Let's get into it. Why is Apple overvalued? Since 2001, the average PE ratio of Apple stock, the average PE, the normalized PE is 25.5. And right now it's sitting right here pretty much on the average PE ratio, sitting at a blended PE of 24.82. So you think it's pretty fairly valued right now based off of this. But wait a second. If we take a look, since COVID, things have just gone insane for Apple, right? The PE ratio has traded up to 38, 34, 30, 29. It's traded way higher than its average, and that has brought the average up. Also, in its early days, it wasn't as profitable. It was growing faster, 333% earnings growth, 260%, 46%. So it traded at a much higher PE ratio for some of this time, 50s and the 50s. So we got to get rid of that time, and we got to get rid of post-COVID to get a better idea of where this PE ratio should be at. So I'm going to remove everything before 2009. I also don't want the great financial crisis in there because that throws things off. And I'm going to remove everything after COVID. Now we get an average PE ratio of about 16 and average earnings growth rate of 30%. And so now the blended PE of 24.8 is actually looking a little bit overvalued from this normalized PE ratio. And so if we go to the forecasting calculator and we look at what analysts are expecting through 2024, they're expecting about 8.5% earnings growth this year, about 5% in 2023, and about 6% in 2024. So if we take this thing and we say, we think it's going to still trade at a PE of 24.8, which I think is high, then through 2024, you're only getting a 6.2% annualized return for a 13% total return. That's the best case scenario, in my opinion. I think a more realistic place for it to trade is down around 22, 22.5. You get a 1% annualized rate of return or a 3% total return. And then even down to 21, which I think is where this thing should be trading at if earnings growth is going to be around 5%, then you're looking at around a negative 4% total return between now and 2024. Let's jump over. This is everything money. We can build a little 5-year scenario here. I've built a low, a medium, and a high scenario based on some potential growth rates and profit margins of the stock. And I'll show you where I got these growth rates in just a second. We saw the analysts are expecting 4 to 5% earnings growth. But let's see what revenue growth is expected to be. So this is ticker. We're just looking at analyst expectations for revenue growth right here for 2022 through 2026. And it's coming in right about at 5.5%. Net income margin, which is the profit margin, 24%. Okay, so that's where I got these numbers from. I didn't just make them up. And I gave us a nice range of 3% on the low side to 6% revenue growth on the high side. Okay, and so then if we think the PE ratio is more fair, potentially up to 20 on the high side, but down to 15 on the low side, and we'll be even a little bit more lean. We'll give it a 16 on the low side, and a price to free cash flow ratio of 15, 17, and 19. We're looking for a 10% annualized return because we can get about 8 to 10% in an index fund. Let's hit analyze and see what happens. Here you go. And this is why I think the stock is overvalued right now. And a price I'd be much more comfortable buying at is somewhere between $106 and $120 a share. This is a fantastic company, so it deserves a little bit of a premium to the market. which I think getting an 18 to 20 PE ratio is pretty fair. But then I think even with aggressive growth estimates, more aggressive growth estimates than what analysts are expecting, and a PE ratio that's about 20 to 30% higher than the average for the market over time, this thing is still showing as not being a buy until it gets under 120 a share. So I'm going to hit notify me when the price goes below 120. And that's the target price that I would be interested in buying Apple at. Again, I own a lot of smaller companies that are going to grow a lot faster. And the reason is because if we look at the way Apple has performed over time, this is back to fast graphs, you could see over the last, since 2001, almost 21 years, Apple has returned 36% per year versus the S&P 500 at 8%. That turns a $10,000 investment into $6.1 million. I don't think my companies are going to do 35% per year, but I sure want to try to get more upside than what I think I'm going to get from just a stable, growing company. There's nothing wrong with Apple as a company, but when I think it's towards the high end of where it should be valued, so I'm not going to get price to earnings multiple expansion where a PE is at 10 and it could go to 15 or 16. That's price to earnings multiple expansion. You can make some great returns that way, but that's not the case for Apple. Apple is trading near its historical high PE ratio, other than the last few years since COVID, when I think things just kind of got crazy. So last place, we'll jump over to Morningstar, see what they think. They've got it at 2 stars, and so that tells you that they as well think it's trading at a premium. They think it's overvalued at a 16% premium. They see modest iPhone 14 upgrades. Okay, we already saw that there's more demand, so maybe they're wrong about modest. But they think shares are overvalued. So even if iPhone demand comes up, then that might just bring them into more of fairly valued in their opinion. And so there you have it. I am not a buyer of Apple right now. I want to see it get down to 120 a share or lower. Let me know what you think in the comments. Do you agree, disagree, and are there any other stocks I should look at? Have a great day, and let's keep investing.